In this lesson, we will be covering Chapter 13. Chapter 13 is one of the most extensive chapters we cover. The topics are basic corporate characteristics, stock transactions, dividends, preferred dividends, treasury stock, and the retained earnings statement. First, let's discuss basic characteristics of a corporation. Corporations can be publicly held or privately held. Publicly held means that anyone, including yourself, can buy stock in this company. Privately held means that only a select group can buy stock. This could be family members, employees, or certain investors. An example is Wawa. Wawa is a private corporation. I cannot buy stock in Wawa. However, Wawa does give stock out to its employees. As we learn about corporations, we will assume that it is a public company unless stated otherwise. Now we will discuss some advantages, then disadvantages of corporations. First, corporations are a separate legal entity. They are treated almost like a person. Corporations can take out loans, they can sue, they can be sued, they can own property. The only right that a corporation does not have that a person does is that corporations cannot run for office. Sorry, we cannot elect Amazon as our next president. Corporations have a limited liability. This is a great advantage. This was not true when you learned about sole proprietorships in Accounting 1. In Accounting 1, we learned that sole proprietorships have unlimited liability. This means that if someone sues my business, my personal assets are at stake. Now, corporations have a limited liability. Your liability is limited to your investment. For example, if I invest $100 in a corporation and they end up going bankrupt, I might lose my $100, but that's it. My liability is limited to my investment. My personal assets are safe. It is also very easy to transfer ownership for public companies. I use the app called Robinhood. I can go on the app right now and buy stock. I can then sell it anytime, and it only takes a few seconds to do so. If you are thinking about investing in stock, the process is extremely easy. Corporations have a continuous life. This means that if the CEO or one of the stockholders passes away, the company can continue to operate. This is different from a sole proprietorship and a partnership where the company will have to be dissolved. Corporations do not have mutual agency. First, let me explain what mutual agency is. Mutual agency is when any of the owners can act as an agent of the company. This is true for partnerships. Let's say you and I start a partnership. We each can individually go out and sign contracts, purchase property, and take out loans in the name of the business. We both do not need to be there. Imagine if this was the case for a corporation. Corporations have an unlimited number of shareholders. Imagine if thousands of people could act as an agent on behalf of the corporation. It would be chaos. Therefore, there is a lack of mutual agency. We do not have that for corporations. As a shareholder, you are investing money and hopefully will earn additional money based off that investment, but that is it. You do not run the company, which is a good thing because I invest in all kinds of companies that I have no experience in. The last advantage is ease of capital. Corporations can raise funds quicker than small businesses can. They may need board approval and shareholder approval, but they can issue more stock or issue bonds if they need funds. Next, we will talk about the disadvantages. The first disadvantage is double taxation of corporations. The corporation is not taxed twice, but the earnings are by the time the shareholders receive their dividends. First, let me explain what a dividend is. When you invest in a corporation, many of them will pay out dividends when they earn money. You can think of it like interest you receive in your bank account. If a company does not earn any money, then they cannot pay you any dividends. They are also not required to pay out dividends. Many do, though. However, many technology companies do not. Now, when a company earns net income, they pay taxes on it. That is the first taxation. The company will then take the remaining earnings and distribute it to the shareholders in the form of a dividend. Their shareholders will have to claim the dividends on their tax returns and pay taxes on the money they received, hence the double taxation. The company pays taxes, and then the shareholders pay taxes all on the same income. The second disadvantage is that corporations have much more government regulations than other types of businesses. Not only do they have to adhere to state regulations, but also federal regulations, SEC regulations, and the stock exchange regulations. Corporate governance is a system by which companies are directed and controlled. Governance is how the company is governed. Who is in charge? What are the different departments? What is the chain of command? Each company can have a different governance structure. I'm going to provide a very generic format. The first part is usually the same for every company, and towards the end is where you will see some modifications. First, we have the stockholders. The stockholders are the owners of the corporation. Remember, stockholders do not run the company, they are just investors. The stockholders will vote for the board of directors. The board of directors are like representatives of the company. They make decisions on behalf of the shareholders. The board of directors are responsible for the hiring and firing of senior executives, dividend policies, and executive compensation. They also help a corporation set broad goals and ensures that the company has well-managed resources. The main thing for you to remember is that they choose the CEO or the president of the company. This is where there are some structural differences among companies, but this is a normal format. The other senior executives include either department heads or vice presidents of each department, such as marketing, finances, operations, and human resources.